All right, there may be no hope to truly tame inflation. That's the subject of the riff. Stock market bulls continue to tout Federal Reserve interest rate cuts. But the latest Fed minutes out today throw cold water on that proposition. By the way, stocks don't need any extra juice from the Fed. The current rally is based on solid profits, which are always the mother's milk of stocks and the lifeblood of the economy. But consumer prices have increased around 4.5% at an annual rate over the first third of the year, and of course nearly 20% over the course of Joe Biden's entire presidency. Prices have risen faster than wages during Mr. Biden's term, as typical working families find it difficult to live in the Biden economy. You could add on personal borrowing costs like car loans, home mortgages, credit cards. All those are not even counted in the CPI, but they weigh heavily on families nonetheless. Then there's the never-ending Biden spending machine and the soaring deficits and debt that go with it. Basically, you're looking at $2 trillion deficits as far as the eye can see. And the root cause of those deficits is overspending, which is running nearly 1/4 of GDP. That's a peacetime record. The CBO estimates that budget deficit's going to run close to $3 trillion by 2034 as spending continues unabated from Biden policies. Deficits estimated to rise to 6% of GDP. It's an unheard of level in an economy with unemployment less than 4% and a still troublesome high inflation rate. Debt held by the public currently totals $27 trillion and is expected to rise from the current 99% of GDP to 116% of GDP. Total federal debt itself now $34.5 trillion. Net interest expense running over $800 billion a year. That's a near unbelievable number that is actually just as costly as our entire national defense budget. And the Joe Biden Treasury is making a huge mistake by financing its debt at the very short end of the curve through 91-day Treasury bills, which are currently over 5.25%. They are significantly higher than 10-year bonds that are yielding about 4.5% in the inverted yield curve. Treasuries should be selling much longer duration bonds to avoid high interest expense and, frankly, to properly fund out the debt burden over a long period of time. Maybe 50 to 100-year bonds would make a lot more sense for future generations than 3-month Treasury bills. The problem with curbing inflation is that while the Fed has pushed down on the brake, Biden's spending policies keep the accelerator on the floor. And that's an inflation problem for the longer term, that is, unless someone else comes along to completely change the policy. And that is my riff.